So you don't buy the fact, Barry, that as long as the economic data comes in fine, the Fed's cutting rates, and inflation doesn't perk back up too much, path of least resistance is higher?
Well, path of least resistance has some bearing on its valuation as well. And we did a note 2 weeks ago saying that the market looked like it was about 2 multiples too high. Each multiple is about $250 of S&P earnings on a forward basis. So that's about 500 points. The S&P would be worth about 53.50. But you're right. Unless we have some clarity on whether it's an extreme soft landing, yes, in the middle, but you could have a hard landing. You could easily have a no landing, which would take rate cuts off the table next year. I think the risk is pretty high right now.
So you think the risk is high of a correction on the idea of a no landing? Because even if it's a no landing and you don't get rate cuts, the market might not be thrilled with that, but it does mean that the economy is in great shape.
Well, a really detailed analysis of inflation, which in this brand new era of populism is not going to stay quiescent forever. In other words, the 2% inflation target of the Fed on a long-term basis is over. It's dead. It's gone. We're in a valley between two moves in inflation. The next one won't be as high as what we saw in 2022, but we're just in a valley, and it's a misleading optimism in the market to believe that inflation's been whipped. We're going to see quite a bit of fiscal, no matter who wins the next in this election. Quite a bit of fiscal, because that's what the public demands. They want fiscal.
Unless the bond market rejects it, of course. So, Barry, what do you do? What are you telling your clients to do if you think the market looks too expensive and you're worried about spending, which could hurt bonds as well?
Well, think about bonds. Yeah, there was a slight move after the strong payroll number, but total government debt held by the public is only 30% of non-financial debt. That's actually fairly low. And we have no term premium in the market, meaning the cost or price of duration risk. That means that the yield is actually very low on 10-year treasuries. So we could issue more debt, and I think the politicians know that. So as far as we look out into the future, we think valuation is just very stretched. We are following a composite of past bubbles, so we could go higher. But unfortunately, when the inflation perks up and the Fed mid-decade is forced to reckon with that, then we're going to go straight back down. And it kind of begs the question, what's the point?
All right, Barry. Well, it's an alternative view. Thank you for joining us, though, with it. Appreciate it.
Thank you.
Highlighting some of the risks out there. Barry Bannister of Stifel.